Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The Bank of Canada says the financial system is functioning well despite U.S. tariffs and uncertainty. The central bank says households and businesses remain in stable condition, adding that lenders have strengthened their capacity to absorb financial shocks. The BOC warns, though, that a more turbulent global environment poses risks to financial stability, noting that the Middle East war has raised uncertainty and market volatility. Prime Minister Mark Carney is in New York to pitch Canada as an investment destination. He'll be meeting with various business leaders and will deliver remarks at the Economic Club of New York. He'll outline Canada's new economic strategy and progress made so far, as it comes as negotiations on CUSMA begin. Shares of BRP are moving higher today after the maker of Skidoos and Sea-Doos posted stronger than expected first quarter results. Revenue jumped 30% compared to the year before, driven by higher sales and improved margins across its power sports unit. BRP also raised its full-year revenue outlook but lowered its profit forecast, citing the impact of tariffs and related costs. And the Bank of Canada is hosting a conference to discuss the findings of its latest financial stability report, focusing on key vulnerabilities in the financial system. Here's more from Senior Deputy Governor Carolyn Rogers and Deputy Governor Tony Gravel.
This financial system has functioned well through a challenging year. Households and businesses remain in stable financial condition, and banks have strengthened their capacity to absorb shocks. However, vulnerabilities in some parts of the system have increased. Stock and corporate debt valuations have risen and are high relative to historical norms. This makes markets more vulnerable to a sharp correction. The issuance of global sovereign debt is also rising, and hedge funds are playing a bigger role in that debt, often using borrowed money. In normal times, hedge fund activity helps keep markets running smoothly. But if conditions become strained, this activity could amplify stress and disrupt core funding markets. Individually, these vulnerabilities look manageable. However, the economic and geopolitical environment has become more volatile. And this has made it more likely that a new shock or a combination of shocks could cause several vulnerabilities to crystallize at once. If this were to happen, these vulnerabilities could interact and reinforce each other. A cascading series of events could cause a sharp loss in investor confidence and lead to a spike in demand for liquidity or to rapid asset sales. Funding markets could come under pressure and stress could spread more broadly. To be clear, the FSR is not about what we expect will happen. It's an assessment of how existing vulnerabilities or pockets of stress could amplify shocks and ultimately spread across the financial system. At the time of the 2025 report, we were concerned that tariffs and trade uncertainty could lead to market volatility, strains on liquidity, or even market dysfunction. So far, the impacts have been less widespread than we originally feared. But of course, the risk hasn't gone away, and the future of Canada's trade relationship with the United States remains uncertain. Plus récemment, l'incertitude mondiale a augmenté à cause de la guerre en Moyen-Orient.
Uncertainty leading to volatility in some markets and also short periods of reduced liquidity. Even with these pressures, markets have continued to function well. But it remains unclear how long the war will last or how it might be resolved.
Are also emerging, particularly from artificial intelligence. AI is expected to boost productivity and economic growth over time, but it's sparking concerns about disruptions in some sectors and about overinvestment. AI may also increase the speed, scale, and sophistication of cyber attacks. Now, let me turn to Deputy Governor Gravel to to talk about the conditions in each of the 5 sectors that we monitor.
Thank you, Senior Deputy Governor. I'll start with households, where the overall picture is similar to last year. Canadians continue to carry high levels of debt relative to their income, but overall household wealth has risen. And the share of borrowers who are behind on debt payments has stabilized. In recent years, we've highlighted the risk of payment shocks when households renew pandemic-era mortgages. To date, most borrowers have managed this risk well. With the final wave of these renewals set to happen over the next 12 months, we expect this risk to have fully passed by the second half of 2027. I'd like to stress that this overall picture masks important differences. Some households face far greater strain than others, and those with the highest debt burden have very little financial flexibility to cope with a job loss or an unexpected expense. Notre vue d'ensemble cache des écarts importants.
I'd like to stress that this overall picture masks important differences. Some households face far greater strain than others, and those with the highest debt burden have very little financial flexibility to cope with a job loss or unexpected expense. Business financial health is broadly stable, even in sectors more exposed to shifting U.S. trade policy, but a downturn could put pressure on margins and make borrowing more difficult.
The main concern for both households and businesses is a geopolitical or economic shock that leads to a deep recession and a sharp rise in unemployment. Canada's large banks have become more resilient over the past year, with higher profitability and healthy capital buffers. They have also set aside additional funds to absorb potential loan losses. This positions them to support the economy and financial system even in a severe downturn. Les vulnérabilités liées au
vulnerabilities associated with non-bank financial intermediaries continue to grow. Hedge funds are taking on more leverage, in part to finance their purchases of government bonds. This supports market liquidity, but it can also be a source of fragility. I will end with financial markets. Recent geopolitical events have led to bouts of volatility, but financial markets have generally proven resilient. To summarize, our overall view is that the Canadian financial system remains well positioned to weather shocks. Over the last year, it has faced repeated tests. While there have been some strains, those episodes did not lead to broad-based financial stress.
The Canadian financial system remains well positioned to weather shocks. Over the past year, it has faced repeated tests. While there have been some strains, these episodes did not lead to broader-based financial stress. Still, we must stay vigilant. We will continue to monitor vulnerabilities closely and remain in regular contact with financial system participants and with domestic and international partners. A stable and resilient financial system absorbs shocks rather than amplifying them, and that benefits every Canadian. With that, the Senior Deputy Governor and I would be happy to take your questions.
Thank you, Senior Deputy Governor, Deputy Governor. We will go to questions now. We'll start with the reporters here in Ottawa at the bank, and then we will go to those at our regional offices. As a reminder to everybody, today's topic is the Financial Stability Report. We will be back here in a couple of weeks' time for an interest rate announcement, at which point we will be happy to talk about monetary policy. We have time to get to everybody if we can just limit ourselves to one question each so that everybody has the chance to participate. And if I forget to do so, please state your name and affiliation. For those in the room, just press that button on the microphone in front of you to activate it so everyone can hear your question, then press it again to turn it off once you are done. Avant de poser votre question, veuillez vous identifier.
Please identify yourself before you ask your question, and of course you are free to ask your question in either official language.
Here in Ottawa, and I'm going to call on Greg Quinn from Market News, please.
Good morning. Sorry for the present circumstances. The report touches on the rise in bond yields and the higher premium that investors are demanding to cover kind of fiscal policy risks and how that could create a financial stability problem. I was just wondering if that rise in bond yields and the potential volatility makes monetary policy more complicated in the current moment.
Well, maybe let me talk about how we view sovereign bond risk from a financial stability perspective, Greg. Really, we think about the reason sovereign bond market is really important to financial stability really comes down to two things. One is it's a reference market. Sovereign bonds provide a risk-free rate, and all other debt is priced off that market. So any instability in that market is going to feed through to other markets. The other reason we really focus on the sovereign bond market is it's core to our funding markets. It's the primary source of collateral in the repo markets. It's the primary source of regulatory liquidity for the banks. So it's really critical to the markets that fund other markets. So any disruption in the sovereign bond market, whatever the source of that disruption, has the potential to feed through to other parts of the financial system. So that's really the lens through which we look at the sovereign bond market in the context of the Financial Stability Report.
And you've been listening to Senior Deputy Governor Carolyn Rogers of the Bank of Canada and Deputy Governor Tony Gravel talking about the report just coming out today, the Financial Stability Report. Overall, households and businesses, they say, remain stable, but there are some vulnerabilities, some concerns about stock and corporate debt has risen, and also global sovereign debt in households. They say they are doing well, but they still have a high debt. They're stable, though, but those in the worst spots are in the worst spots. They have very little wiggle room, and any kind of a downturn or shock could have a huge impact on our countries. That's an update for you from the Bank of Canada. Coming up, Canada's big banks just delivered another round of earnings beats, but with the economy slowing, can the run keep going? Stay tuned. Canada's big six banks beat earnings expectations across the board this week, and most of the group is up sharply in 2026. So are the easy gains behind them, and what's worth owning? Let's get into it now with Diana Avdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, thanks as always for joining us.
Hello, Roger. Thanks for having me.
Okay, the big six are in. Are they all winners? Are there some winners? Are there some losers? Who leads the pack?
Well, they've all been winners this quarter. However, they're all coming from a different direction. At Barometer, we own 4 of the large 6. And that, for me, is what I want to say is you want to build a portfolio. They're going to tread in different ways at different times. This quarter, the theme has been asset management. Wealth has done extremely well, as it has been doing recently. And as long as the stock market does what it does globally, that's going to work. Wealth, portfolio management, capital markets. We have a year where we're going to have a lot of moving parts in capital markets, whether it's M&A, whether it's IPOs. So as long as the stock markets are doing well, which they are, that segment is going to do well. In addition, our banks have been very conservative. When last year the tariff talk started to come through, they've made sure that they've put aside enough for a rainy day. So now we're seeing this PCL normalization, NIM expansion, net interest margin expansion relative to last year, and fee income strength. Can it go on? To your question, yes, it can, in the status quo. There's been a lot of surprises in the market. A year ago, we wouldn't have thought that we'll be here, both in terms of the macroeconomy, GDP, capital markets. So lots of moving parts. Lots of people don't understand why the stock markets don't care about oil at 100. And yet we're having a great earnings season. Companies are making money and the economies are reflating.
All right. Which of the you said you own four? Which four do you own, and who are the two that you don't, and why?
Yeah. So we own National, up 23% year to date. Local, incorporating their M&A, great ROE. We own BMO, but it's up 29.5% year to date. Lots of U.S. business, which is helping. Hedge fund and long only asset managers really like this turnaround story. They can, there's room to grow ROE here. We own Royal. That has been long-term best performing bank, but a little bit less year to date. It's kind of been the funding trade. It's a little bit more expensive than the others, but it's Canada's premier bank. Really also fantastic ROE, great wealth management. And we own CIBC. It's up 29% year to date. And the reason I'm mentioning how much they're up year to date is to benchmark it into perhaps the next question, should you buy them right this today? There could be a little check back because they've done so well. What we don't own is TD. They had a great quarter, and it's also up 21% year to date. But we don't own it because they had this AML issue. Their assets are capped in the U.S. until that clarifies. So where growth comes from is going to be a little more challenging. There could be growth. They could be taking market share, but we're okay with the four that we own. And the other one we don't own is Bank of Nova Scotia, also up 9.5% year to date, but below peer ROE. Their Latin American business has been dragging them down.
And what would it take to get you interested in those two?
You know, like I said, TD had this issue with the AML legislation in the U.S. And if you look at other examples, say U.S. banks that have had the same issue, it took a few years for American regulators to free them up from this overhang. So sure, they can make an acquisition to create growth or take market share, and that would cost some money for sure to try and trigger clients away from other banks. Would have to create some incentives, so that could cost some money. So we need to see some kind of resolution or light at the end of the tunnel, or when this thing could be over. And for Bank of Nova Scotia, below peer ROE, we'd like to see that start moving upward. It is currently a funding trade. There's been some short covering on that the last couple of days for sure. We'll need to see some better headlines on that front.
All right, and then bigger picture, where do your feelings lie with it? It's been an interesting run, hasn't it?
Really has been. Like I said, if a year ago we would have talked about higher inflation, and I would have asked people, what do you think if oil jumps from 65 to 100? What's going to happen to equity markets, or the macro situation, or the AI trade and what it does to labor? All of these are potential things that can create disruptions. AI to labor market then feeds into consumption. Consumption feeds into the slowing of the economies. But that hasn't happened, as a matter of fact. And that's another thing for the financials. These banks, I think, tend to benefit a lot from AI productivity gains. You know, us in asset management, including myself and all of us here at Barometer, we use AI more and more to source data, to source research. It's happening everywhere, and it's happening at an exponential rate. It hasn't disrupted the labor market. So markets feel to me a little bit tired, not broken, just tired. We really are coming into next couple of weeks, few weeks. We have the SpaceX IPO coming. It's going to suck a little bit of assets away from some other stocks, perhaps, and we have month end. We're up 20% on the S&P since March 30th. There is a calculation that those accounts that rebalance between their different asset classes, there is about $60 billion calculated to be sold out of equities and perhaps rebalance into the bond markets. So that could put a little bit of a hold. Volumes have been light, so maybe a little digestion.
All right, we'll leave it on that note there, Diana. Thanks as always for joining us.
My pleasure.
Diana Avigdor is Portfolio Manager and Head of Trading at Barometer Capital Management. Coming up, today's market drivers with Bloomberg's Monique Malima. Well, time to take a look at today's market movers, and for that we are joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. There you are. Good to see you. How are you?
I'm good. How are you?
Excellent. Everpure, it's not so well right now, dropping.
Yes. So Everpure, they reported their results today, and their revenue guidance came in lower than analysts were expecting. And this is largely due to the fact that they actually had really strong quarterly results. There was growth that the company's been seeing due to higher prices and higher pull-in. But with their full year revenue guidance, it's now implying that the growth is going to be slowing in the second half of the year, taking into account how they performed so far this year. So analysts are a little disappointed with that. They had expected the growth trajectory to continue for the company. And they also know that the company currently has an agreement in place with Meta as a hyperscaler, but they didn't announce any new deals. So that's something that people had also been looking for them to be able to sign on more clients.
All right, going the other way, Encino, they're up today. They're still up. They were up last time I looked.
Yes, so their shares are higher after they boosted their full year revenue forecast. They've been seeing growth in subscription revenues for their cloud banking platform, and a lot of this has been driven by their foray into AI. They've been offering more AI capabilities, and their users can buy AI tokens that they can use for different features on their platform, and they've seen a lot of growth from this. So this is something that analysts are expected to continue for the company, and they note that this also helps insulate the company from being disrupted by AI because it's embraced the technology so much and that their customers have responded well to this. This is really going to help them kind of address some of these growth areas in the market.
All right, to continue, the yo-yo ATS down today.
Yes, so ATS, their shares are lower after their revenue growth forecast came in lower than analysts were expecting. The engineering firm has seen some strength in consumer products and energy, but there was weakness in life sciences for the quarter, and some of that weakness is expected to continue. Analysts are saying maybe it's possible that the guidance was a little conservative, but it still points to a declining growth trajectory, which is the reason why we're seeing the shares lower.
All right, Monique, thank you for that.
Thanks.
Bloomberg's Monique Malima. Coming up, Canada's on the cusp of a major wave of investment in energy and infrastructure. We'll find out what it could all mean for the country's economic future when we come back. Oil prices are lower on the news of a renewed push to end the war in Iran. Axios is reporting that Iran and the U.S. have reached an agreement on a truce. The report says the truce is for a 60-day extension of the ceasefire and for negotiations to start on Iran's nuclear program. U.S. President Donald Trump still needs to approve the terms. The report comes after the U.S. carried out airstrikes on an Iranian military site overnight. The Bank of Canada says the financial system is functioning well despite U.S. tariffs and uncertainty. The central bank says households and businesses remain in stable condition, adding that lenders have strengthened their capacity to absorb financial shocks. The BOC warns, however, that a more turbulent global environment poses risks to financial stability, noting that the Middle East war has raised uncertainty and market volatility. The union representing workers at Canadian Pacific Kansas City has delivered a strike notice. The organization says about 300 track signal workers will walk off the job on Sunday. It says the workers are concerned about wages, work-related experiences, and work-life balance. CKPC says railway operations will continue in the event of a strike and maintains that its offer is fair and balanced. Talks are expected to continue over the weekend. And taking a quick look at the markets, there's been a turn for the TSX, running in the red a lot of the morning, and now you can see it is into the green, albeit barely, and that's mostly on the news of what's unfolding south of the border. Tech is leading the way for the TSX right now, and heading to the U.S., taking a look at the markets there. And they've kind of taken off on the news that talks towards an extended truce between Iran and the U.S. continue, and it looks like there will be a new truce. And you can see the S&P 500 pushing into record territory again. Actually might just be slightly above it right now. It's up a half point. And the NASDAQ doing the same as well. It is, it's beating the all-time record high set earlier. It's up by 0.66%. Well, Canada is about to see a huge wave of investment across the economy, from energy to infrastructure. But the big question is, will that money help build a cleaner, more resilient economy, or lock in longer-term risks? To find out more, let's bring in Elliot Capel, the National Climate Change Leader at PwC Canada. Elliot, thanks very much for joining us.
Thanks for having me.
All right. Are we on one of those cusps right now about where we're going with cleaner energy?
Yeah, absolutely. We're at sort of a crossroads in sustainable finance more broadly. As you noted, we'll be investing billions, if not trillions of dollars into housing, infrastructure, and defense. And the way we do that is consequential. Will houses be resilient to the impacts of wildfires or flooding? Will infrastructure set us on a path towards net zero 2050, or will it push that path further out?
And with that, what are the things that will push us towards that, and what are some of the things that maybe will have us hesitate? I'm guessing money is one for hesitating, but what are some of the things that will say we need to do this? It makes sense.
Yeah, well, absolutely. We need to address the physical impacts of climate change and infrastructure. That is, of course, for our own business case, because the physical impacts could impact operations and maintenance, useful service life, or other physical impacts, but also to make us competitive in attracting that investment globally.
And are you worried? I mean, south of the border, we had the president say, drill, baby, drill. Energy with everything that's unfolding in the Middle East. Oil here is obviously has garnered renewed interest. Are you worried that's going to overshadow any push towards more greener, cleaner energy sources?
Well, so far it hasn't. It's been more of an all of the above sort of answer to the question. We're seeing record investment in solar, wind, renewables, batteries, and as the cost comes down and the availability goes up of those alternatives, we're going to see again more of an all of the above sort of approach to energy.
And what will keep driving that? I mean, if we see oil prices drop back down to say $70 a barrel, will that interest be lost, or does it feel like there's the commitment there for those fields?
I think there's a need for an all-of-the-above approach. When we look at the energy demand, and the government underlined this last week when they released the electricity strategy to double the availability of electricity. Well, that's going to have to come from a variety of different sources, which include, of course, traditional energy sources, but renewables, batteries, nuclear, solar, and hydro.
And where is Canada in all this? I mean, nuclear, I imagine we sit near the front, but how about other energy sources? How are we doing?
Well, Canada is definitely a global player in energy. You noted nuclear. We have some of the world's leading investments in the Canadian nuclear sector, but also in hydro. And then some of the largest investors in energy globally are based here in Canada.
And one of the things you say is that we're moving beyond disclosure. So what does that actually look like in practice for investors when you say we're moving beyond disclosure?
Well, sustainable finance in the last, let's say, decade was really focused on like labeling. So are the goods and products and services that you're going to buy sustainable or ethically sourced? And if you walk the halls of the grocery store, you see the impact of that. What we're shifting is from a consumer markets focus to questions that are fundamental about the architecture of the Canadian economy.
And with that, is the money coming? Is the money following this?
Absolutely. You see record inflows of sustainable finance in various areas, but it's not all a good news story, right? There's a lot of change right now. We're definitely at a consequential moment for sustainable finance in Canada and globally.
And what do we need? Where are we falling short? Like, what do we need to change to try and draw more money in and continue this drive?
Well, absolutely. We need to, as I said before, assess the physical impact of climate change on our investments. But there are also questions around, for example, a Canadian taxonomy, which is live at the moment, so that we can say what we mean when we say something is green or when we say something isn't green, what falls in which bucket. We need to make that very clear for investors and indeed for consumers as well.
And it comes back to the money thing I mentioned about it's cheaper to get oil out of the ground right now. Is it becoming cheaper to find alternate sources of energy and use alternate sources of energy so that it will draw more people in?
Absolutely. When you see the cost curves for just about any technology, they go, down and to the right over time. And that isn't specific only to energy, by the way. It's to a number of other aspects of this conversation. So, for example, when we think about making infrastructure or homes more resilient to the impact of climate change, we see many more solutions out there in the market. And we see that also for the availability of something like even as simple as a heat pump in your home by comparison to a traditional furnace.
And what's the better way to drive this? We tried government regulation. We're now going a little more towards free market. Is there one way or the other that's better, or a combination?
I mean, ultimately, the market is going to flow capital to safer, long-term, resilient bets. And so I think the role of government is to create the conditions for that capital to flow properly and for Canada to compete for the capital that aligns to our long-term growth and to our values.
And does it feel like the country's starting to do that now when it comes to cleaner?
I have to say, when we hear from our clients and what we're seeing in the market, there does seem to be a consensus forming around the need to create those conditions. But back to what I said earlier, we're definitely it feels like we're at the precipice of a moment. Sustainable finance is at a crossroads where it's moving from that labeling regime that I talked about earlier to something that's simply higher order and fundamental, and that's a big moment.
All right, Elliot, we've got to wrap it up there, but thanks very much for joining us.
Thank you.
Elliot Capella is National Climate Change Leader at PwC Canada. Up next, power sports equipment maker BRP cuts its full-year profit outlook and says U.S. tariffs will weigh on results. We'll have details after the break. BRP, the maker of skidoos, sea-doos, and other power sports equipment, is trading higher today. It posted weaker first quarter earnings and revenues were up nearly 30%. But BRP expects U.S. tariffs to weigh on its performance and has cut its profit outlook for the year. For more on the numbers, let's bring in Jonathan Goldman, analyst, diversified industrials at Scotiabank. Jonathan, thanks as always for joining us.
Good morning. Thanks for having me again.
Okay. Is this what you expected for BRP?
I would say no one knew what to expect.
They've had a tumultuous year, haven't they?
It's been a tumultuous half decade, I would say. I mean, I think a lot of companies could say that. If we just rewind, a bit, what happened is, I guess 6 weeks ago at this point, BRP withdrew their guidance from the year. They suspended guidance, and that was because of the change to S-232 tariffs. Previously the company was only paying tariffs on the content of the steel and aluminum in their units, and then all of a sudden overnight they were subject to pay the 25% tariff on everything. So they withdrew guidance, and at the time, about 6 weeks ago, they said it would be a $500 million hit to EBITDA. Today, and to their credit, they reinstated guidance, and they've cut that bill down to only about $300 million. So probably better than feared, probably better than anyone expected, if they expected anything. Pretty impressive what they did so far.
Do we know why the change, that drop? What is that, a 40% drop? Or about a 40% drop, I guess?
Exactly. So the original hit was a 40% drop to earnings. They've cut that down to only a 25% hit to their earnings. A bunch of different factors. One, the industry has been better than they thought it would be. The seasonal demand for snowmobiles has been stronger. There was a better promotional environment than they anticipated. The other off-road products are doing well. But the other piece that's truly remarkable is they found an incremental $200 million of cost savings and other initiatives in the business. This is overhead reductions, nominally raising prices by less than 1-2%, and some other efficiencies to offset that tariff bill. So pretty amazing that you could just look around in 6 weeks and find $200 million of savings to offset that bill. So the management team, the entire business definitely deserves a lot of credit here.
Now, does that seem extreme, or does that tell you that maybe the company wasn't running as tight as it should?
I mean, drastic times call for drastic measures. What's amazing is they took these actions and they haven't impacted the long-term profitability or outlook for the business. BRP is a diligent, well-run business management team. They're always looking at innovation. So they haven't cut any costs or corners here that would impair the long-term fundamentals. I think they squeezed out everything they possibly could, maybe delaying some in-house projects or development, looking for ways to save here. But I don't think it was run any tighter than it should have been. It's just, drastic times, people will find whatever they can do to kind of find some savings there.
Okay, and CUSMA, I mean, that's been the center point for them. The negotiations are coming up. What are they expecting? What are they bracing for? Or they kind of have two paths laid out for themselves?
That's it's the $1 billion question. Originally it was just USMCA, right? And then we have this separate section piece called S-232. So on the earnings call today, the company said that, their going in assumption is we'll see a convergence between those two pieces of legislation and trade policy, meaning, if there's some sort of resolution on USMCA and we restore, what actually is supposed to be a free trade agreement, we could see the same thing sort of resolve itself on S-232. So I think any sort of negotiations, any sort of talk, that's the next catalyst for the company, for the stock. Obviously, it would help visibility. I think all parties, on all sides of the border and the three countries are looking for some resolution. I think everyone has come to the realization, lack of free trade doesn't help anybody. Sure, there's always things that can be improved and we could repurpose manufacturing and, and protect some industries. But I think everyone understands that it's to everyone's benefit to come to some sort of agreement.
And are you surprised at the increase in sales? I mean, we've talked about a lot of people seem to be struggling, but then we see this from essentially in many ways recreational vehicles, or were they stronger commercial sales for them?
That's a really good question, right? So you hit the nail on the head, right? The economy is not great. It's not like people are running. You see the consumer confidence numbers to go out and buy things. So I guess that was surprising on the demand has been more resilient than we expected. Part of that is seasonal, really strong snowmobile season. The other piece to it, and you probably know this as well, is do skews more recreational than utility or commercial vehicles. So what's surprising here, or I guess maybe we should have known, is Do's products tend to target a wealthier household, a more affluent household, and they've been holding in relatively well. I mean, I think I've heard from one corporate that you're going to need gas prices to go much higher than $4 a gallon before people stop buying $800,000 units, second cars effectively. So that's kind of been the story here. High quality units, performance-based, wealthy households, and they've been resilient and they've been buying these new products, which have been actually really well received, the new models they've released.
They have an $800,000 recreational vehicle?
Not that much, I think it could go up to 100, maybe 120, okay. Not that high. It used to be in the boats, but they tend to be in the $35,000 range and all the way down. Yeah.
And so you have it at $80. What did I do? Yeah, $80 for the stock. Where any changes on that, or are you still solid on that?
We're still reviewing our estimates. What I would say is what the results do today is they add more clarity to the story. If you looked at consensus going in, I think the range of estimates were anything from $700 million of EBITDA all the way to $1,200. So wide range. No one knew what to expect. What this does is it really solidifies the bill, at least at this point. Obviously, things can change depending on what social media comes out. But at least now we have something to set a peg to, and we can kind of forecast earnings. And, any time when you have more visibility and more certainty on forecasting earnings and free cash flows, it has positive implications for the stock and valuation, which investors prize. All
right, we'll wrap it up there, Jonathan, but thanks as always for joining us. Appreciate it.
My pleasure.
Jonathan Goldman, analyst at Diversified Industrials at Scotiabank. Coming up, shares of Salesforce are down slightly after the company gave a lukewarm outlook that failed to ease investors' concerns about AI disrupting the software business. That's next. Salesforce delivered a lukewarm outlook that has added to concerns about how AI could disrupt the software space. The stock is now down more than 30% year to date. For more on this, we're joined by Rishi Jaluria, Managing Director of Software Equity Research at RBC Capital Markets.
Now the stock's reversed course a little bit, so it's up about 2% this morning, after being down in the aftermarket. And look, I would say, generally the reaction is a lot of investors are still in wait and see mode because, as you correctly kick things off, we're dealing with these existential fears around what does AI mean for software and especially application software. And, we can get into the puts and takes of that debate. And, while I think Salesforce had what I would say was a pretty good quarter, things were, generally in line with what people expected to see. You saw really good momentum out of Agentforce. They reiterated their confidence in accelerating growth in the back half of the year and kind of sticking to their long-term targets, which called for kind of durable acceleration. All those pieces are there, but I think a lot of investors still are in, I'll believe it when I see it sort of mode, especially given all the headlines we keep hearing with, Anthropic, with OpenAI, with AI natives, and, what's happening out there. So I think that's why maybe the stock reaction is still muted, even if it's more in the upward direction today. But, if they can put up a few more quarters like this and actually deliver on what they're saying, we might be having a different conversation 6 months from now.
Right, and that's the case. And then let's, get into that a little bit more too. You touch on Agentforce too as well, right? Some of the expectations, maybe on track to contribute $1.2 billion of revenue. How significant is that, and could that be, assuming it does follow through, because we know that there have been some issues with it?
Yeah, look, I think it can be significant, right? Now I think the question starts to say, well, how much of that is cannibalizing the core, which, candidly is a right decision. I think every company needs to do that, but there are going to be questions around that. But ultimately, if this, big growth in Agentforce leads to overall acceleration in growth at the company, it's really hard to, argue that it's an AI loser, right? If they're actually accelerating growth, not decelerating it. So they kind of have to work through the puts and takes of that and think about, can they accelerate overall organic growth? I'm still on the sidelines on this because I'm also in wait and see mode. But, again, if they can actually, if Agentforce gets big enough that it becomes a needle mover on overall growth, that could be another factor that helps drive that acceleration and ultimately position Salesforce better for the next decade than it may be today.
Yeah, and can it do it, Rishi? Because, Bloomberg reporting to just last week, and we talked about the fact of what is realistic, what they are marketing Agentforce can do, what it could be, but that in actuality, when it comes to practical applications about in pharmacies or otherwise, that it's not actually doing what the company says that it's doing yet in practicality. So when you have that discrepancy, how tentative are you about that growth for it?
Yeah, and I think you hit on one of my concerns, right, which is there's the promise of Agentforce and there's where it is today. That's not to say that gap can't narrow over time, right? And I think it fundamentally will. But I think we need to get there. Now, I think if we take a step back, though, what maybe I think starts to become a lot more important is, number one, are enterprises willing to use, adopt, and pay for Agentforce if the technology gets meaningfully better? And I think the answer to that can absolutely be yes, especially because Salesforce is already a trusted vendor within all these organizations. If they want to use Agentforce, they don't need, major permissions to do that. If they want to go build their own custom agents using, Anthropic and OpenAI and Replit and Lovable, that creates a whole security and governance nightmare. And the answer to that is going to be absolutely not. So I think the technology needs to continue to improve. I've gotten the sense that Agentforce has gotten better over the past year, but there's still a lot more work to be done.
So your target for Salesforce is $210 a share, right? So we talk about $40 a share higher. Is it mostly the growth of Agentforce that you like for that, or is there something else here that Salesforce can, again, continue to improve upon for that growth?
Yeah, look, I think the answer to that, and, again, I'm still generally on the sidelines, but I think two things. Number one is, there is that potential for acceleration of growth with Agentforce and maybe even just, refocusing on the core, which we've seen them do. But I think the second thing is, the stock is pulled back to a point that it is actually, I think, unreasonably cheap. And so even someone, a year ago, someone would have called me a Salesforce skeptic. Now I'm in the camp that I actually have to say, hey, the stock is actually, meaningfully cheaper than where I think fair value is. I do think there are other opportunities in software that might be more attractive. And, I've been steering investors in that direction. But when I see Salesforce trading at 10, 11 times cash flow, it's hard for me to say that the stock should be trading lower than where it is today.
Okay. Before I let you go, give us a sense of where you're steering, if I can ask you about that, where are you steering others to as we talk about this in software, at least for right now? It may be a couple of options.
Yeah, absolutely. Look, the number one name I'm steering people to is Microsoft. I think the innovation that they're really starting to bring to M365 Copilot is, underappreciated. And we're starting to see those early signs of momentum there. And I think they're making the right strategic moves for the long term. So I think they're going to end up in a good position out of this. One of the, a Salesforce competitor that's more in the small and medium business space, HubSpot, I think that could be a long-term beneficiary of AI. And then and hopefully I don't regret saying this in a few hours, but one name that I like a lot here is MongoDB, next-gen database company. They report tonight. It's one that I think could become the de facto platform for the development of new AI applications, especially those leveraging unstructured data. And I think these are three names that I really like here that I think are really well positioned for the next 5-10 years.
And Matt was speaking with Risha Jaluria, Managing Director of Software Equity Research at RBC Capital Markets. And a quick look at the markets before we go. On Bay Street, you can see TSX back into the green, up by 0.33%. A lot of the markets reacting to the news. It looks like there is an extended truce coming possibly in between Iran and the U.S. The banks reporting today, most of them are in the red right now, or the three that reported today and the three yesterday, most of them are in the red right now. And heading down to the States, quick look there. And no surprise, S&P 500 on that news up by more than a half point into record territory. NASDAQ the same, up by 0.66, also into record territory. Market calls coming up next. Today on the show, we have Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. He'll be taking your questions on North American equities. Thanks for watching Morning Markets. I'm Roger Peterson. We'll see you tomorrow. Have a great day.